Welcome back, everyone. Before we begin with our next session, I just want to give you all an opportunity to ask any questions that you might have for Andrea from the previous session. I see also that we've had some response to the chat from Abdul. Thanks, Abdul, for that comment. Now's an opportunity to ask any questions if you have any. If not, then I will hand over to Kofi for session 5 on regulation and supervision supporting inclusive insurance markets.
Sorry, I had the question.
Oh, sorry, go ahead.
I'm just coming late. Okay. So Andrea, on one slide, she showed us that the balance between consumer protection and market stability versus responsible development of inclusive insurance. So which side weighs more? That was my question.
Sorry, could you please repeat the question?
Yes. So there was that slide whereby you showed us the balance between consumer protection and the financial stability versus responsible development of inclusive insurance market. I remember there was that diagram. So I just want to find out which side weighs more than the other.
Well, I think that precisely that's the objective of implementing the proportionality principle, because the role of the supervisor authority is really making sure that both sides are equally balanced. So it's important to promote development, but also that development needs to be responsible. So if that approach is adopted, like developing a responsible inclusive insurance, there will be a balance. So I would say that it really depends on your country. Sometimes, like, there is one side that weighs more, but I think that the role of supervisor authorities really try to make sure that this is equilibrated.
Thank you.
Thanks, Edwin, for that question. I'll just wait a few more seconds unless there's further questions to be asked. If not, then I'll hand over to Kofi for your live session on prudential issues.
Thank you, Pascal, and welcome all of you to session 5 on the prudential issues. So yesterday, or since yesterday, we've started this yesterday, and Andrea took us through the main barriers for inclusive insurance. Andrea talked about 4 main categories of barriers. So we looked at the demand side barriers and the supply side barriers and the policy barriers. And then we look at the supervisory barriers. She did mention yesterday that this course will focus on the supervisory barriers and how to deal with them. Of course, we are all supervisors here. But on the supervision side, you have roughly 2 sides. You have the market conduct and then the prudential supervision. Andrea will talk, a lot of the sessions she would have will focus on the market conduct issues. This session will take a specific look at the market conduct issues, the market conduct supervisory issues that tend to be barriers for inclusive insurance, and what we could do to ease those barriers so that our supervisory structures, systems, approaches could support inclusive insurance. So that's what we are going to look into in this session. And talking about the prudential aspect, the key things that jump out are to do with licensing, solvency, and capital adequacy issues, of course, governance, risk management, internal controls, and then ongoing supervision. These are the key issues when you talk about prudential issues. So we will look at these, and I am sure, hope that we have all gone to the online model and looked into, gone into detail on these issues. But we'll briefly look at these, and we'll do a couple of group work and share our thoughts and share ideas. In the introductory section yesterday, most of us did say that we want to share experiences, share knowledge, and so that is exactly what we'll be doing in this session. So let's look at these sessions. So licensing is a very important supervisory tool. It is a very important supervisory tool. It talks about what should be regulated, who should be regulated, what the licensing requirements are or should be, and how to deal with unregulated activities. You would realize that all these talk about who ends up in the market, what do they do in the market, and what are they dealing with in the market. So who qualifies to play in the market, okay, and what are they doing in the market, how do they qualify to get onto the market. And you can see some of the issues that we talked about, especially when we talked about the supply side barriers yesterday. We went over briefly some of these issues, especially about risk carriers and other entities that are allowed into this space. And so the regulations should go about it in such a way that we should be able to support inclusive insurance. So when it comes to what should be regulated, you are talking about regulated activities. So what should be a regulated activity? And as much as possible, those should be defined as broadly as possible so that we don't leave out any gaps that would create problems. Any activity that is regulated or that should be regulated, the definition should be done in such a way. You can look at this from the value chain, from the sales, the marketing, the sales, the onboarding, the claims, the complaint. These are all activities that we need to take a look at in allowing who gets into the market. And looking at the inclusive space, what kind of entities would we need to play these roles, so that when we do our definitions, we don't stop these very entities that we need from getting into the market to be able to play the roles that we want them to play. Now, who should be regulated? Who is eligible to be regulated? Now, this is a very key policy issue that needs to be taken into consideration, especially where we are setting up the inclusive insurance regulatory framework. It is a very important issue that needs to be well regulated, and as much as possible, this needs to be carefully thought through, because each choice that you make has implications. I know in some jurisdictions they have dedicated micro insurance entities. In some jurisdictions, they have a wide range of institutions that are permitted to do inclusive insurance, and yet in some jurisdictions, you would have the risk carriage restricted to the conventional insurance companies, but the distribution sector being liberalized to a lot of entities. So Ghana and India are structured like that. You would see that carrying the risk itself is restricted to conventional insurance companies, but the distribution field is very widely liberalized, so that you could find a whole range of institutions being allowed to get into distribution, but the carrying the risk is. And then you find jurisdictions like Philippines, where the risk carriage is widely liberalized. There are a whole lot of institutions that are allowed to carry the risk. There is no straitjacket. Do what works. One size doesn't fit all. But as much as possible, the regulation, the definition of who is eligible to be licensed must be wide range, must be diversity. And if we don't do that, we create restrictions, unnecessary restrictions, and those restrictions could create barriers. So we need to think through, both for the risk carriage and the distribution field, we need to think through how to be as diverse as possible, so that we can remove the barriers that could impede the distribution of inclusive insurance. Now, the licensing requirement, what conditions that the entities need in order to qualify for a license are quite important. So in drawing the requirement, we have to be quite sensitive about what works in the inclusive insurance space. Now, if the licensing requirements are so onerous, we will be restricting access to insurance. And if they are too weak, we'll be exposing consumers to a lot of risk. So this is the kind of balance that Andrea was talking about, or an example of the balance that Andrea was talking about earlier. Or you need to strike a balance here, because on either side, on the other side, extreme side, you have risks. And so you need to strike a good balance so that you manage the risk on each side. Whilst you don't want to have extremely weak conditions for entry, or you don't have very onerous conditions for entry. You must have suitable conditions for entry, so that what you put in will be at the right time. The licensing requirements need to be carefully designed, communicated, and applied, in order not to create any barriers. And the procedures also need to be adapted. We should not just transfer what is done on the conventional side. Let's see how we can adapt them based on the kind of entities that we are allowing into the space. So, for example, if you are allowing mutuals to operate in the inclusive insurance field, you know, mutuals do have features that differ significantly from limited by shares companies. And so the capital requirement, mutuals mainly rely on guarantees by the members. And so the capital requirements and the solvency requirement need to be drafted to suit them. The governance and the other requirement, which we will touch upon, need to take into consideration the nature of the entities that we want to allow to play a role. And then, of course, when we have done the licensing, how do you deal with existing unregulated activities? That is very important because formal financial services are the ideal. The idea or the objective is to, as much as possible, protect all consumers and ensure stability in the market. And so how do you deal with the unregulated activities once you have applied the licensing issues? So these are key issues that we need to take into consideration, and especially where we design, or depending on how we design the framework with respect to which entities are eligible to play roles in the market. And it's important to pay attention to these issues. So we were talking about being flexible and so on this slide we said the entities that are eligible, we have to get a wide range and we have to be diverse. Yes, I see a hand, Peter. Peter, please go ahead and ask your question.
I think you're on mute.
Yes, okay, sorry. Okay, so my question really relates to how do we deal with unregulated activities? I think this is one area that actually we are struggling with, because you find that these unregulated activities cannot be able to be transferred to become risk carriers because of the requirements. But most of these unregulated activities continue, and we are not able to also bring them on the distribution side. So what are the things that maybe you can share with us in dealing with these unregulated activities? How do we deal with them, knowing that they're not able to get to the level of being a risk carrier, but the work or the actions that they are doing on a daily basis are of a risk carrier?
Thank you, Valesi. So if you go through the online model, I talk extensively about formalizing the informal market, and I touch on a few issues there. So we need to identify what we want to achieve when we want to formalize. Identify what do you want to achieve? What do you want to see at the end of the day? And then we need to lay out transitional arrangement. During the transition, how are we going to deal with those on the ground? What milestones are we going to give them? And then we need to deal with the mop-up plan. Of course, looking at the situation, we need to design a framework that will be, so initially I said that the regulatory framework should not follow a one-size-fits-all, and that each jurisdiction needs to look at exactly what is there on the ground and design the framework probably to suit it. I would be very grateful if you could go a little bit into why the carriers in your jurisdiction cannot be formalized. I think you alluded to something like that. The carriers cannot be formalized because of the requirement. So is the problem your requirements, or the problem is with the kind of nature of the carriers that you have on the ground? Can you go a little bit into that?
Thanks, Kofi. I think maybe the first challenge is that the unregulated activities of these carriers are basically it kind of started from a situation where they've got these informal burial societies, where there's no capital requirements, in terms of a burial society. So meaning that if someone passes away who's part of this society, there will be, contributions that are done, as and when. But that system kind of became a little bit formal, where there was, money in the bank, for these unforeseen circumstances. But the way that they are running these informal burial societies is a little bit different from the regulations. So when we look at the two, we're like, okay, we're not able to bring them on board because their business models are very different, are very informal, by nature. But the work that they do, or they are actually insurers, for the community. So I think what we actually did, we kind of gave them exemption, to say you can operate if you are doing this for an amount below, let's say in our case, 5,000 rand, which is about one. Yeah. So, but the problem is that they grow and become bigger, but they don't want to then move onto the regulated space, even when they've actually grown. And obviously, we believe then that they are actually they've got risk that can actually impact on the market.
Okay. I don't know. I think something went wrong with my. So I see another hand up. So let me react briefly to Velas's issue, and then the hand up could come in. So yes, you need to look at the situation on the ground in trying to do the formalization. The formalization needs to be suitable to the situation on the ground. And a jurisdiction that I know has handled that quite well is the Philippines. Again, in looking at the barrier societies, what kind of legal entities are we considering them? Mutuals, as I mentioned, really have capital that is mainly in the form of guarantees. So probably looking at the issues on the ground, do we want to organize these societies into mutuals? Of course, I'm not very conversant into all the company law issues in South Africa, but is it possible to organize the funeral societies into mutuals, and then we'll have some governance requirement around it that will help them to be regulated, because it is really desirable, especially because of the protection of the members, as you say, that these societies, some of them have grown into really large sizes. It is important to ensure the protection of the members of these societies. So looking at the issues and trying to get some tailor-made arrangement that will allow the regulator to have some hand on the protection, whilst allowing these entities to offer the services that they continue to offer. I saw another hand up. Yes, Imam Miller. Yes. Imam Miller. Himla. Sorry, Imam Himla, can you just unmute and ask your question?
They have no microphone, Kathy, and they've just written in the chat.
Okay.
But we also have a question from Safwana, I think.
Okay.
Yes, hello, good morning. I'm Safwana from Mauritius, and I would like to bounce back on what Peter has just mentioned regarding the burial companies. In Mauritius, we do have this issue with regards to the funeral scheme. We had some years ago, in 2017, I think, noted this issue, and we came with a regulatory framework to regularize these companies so that those doing the funeral scheme, they come under our ambit for supervision. The issue is that these companies were in existence long before, and they were collecting funds from the public with regards to the funeral services. And from the time that they were requested to submit an application and to be regulated, we are still having this issue. We can't regulate them because they can't meet the solvency requirement, they can't inject additional capital, etc. And we are in a kind of a situation where we want to protect these plan holders, and at the same time we are not able, we are giving them time, we are in constant communication with them, giving them deadline to meet the requirement, but they are not able to fund that capital to be able to meet our regulatory framework for licensing. So this is the issue that we in Mauritius we are facing right now.
Well, thank you. But as I've mentioned, maybe we need to look at the legal entities that we possibly that they are using to carry on these services. If we are able to consider them or register them as mutuals, then we may be able to have a way around the capital requirement so that we could give them some level of protection, the members, I mean. So something that I'll recommend without having a lot of insight into the corporate law issues in your jurisdiction. Safwana, did I?
Yes, I would like to add on that. Actually, the way they are structured is not through, here in Mauritius, we call it not mutual, but associations, where the members can come and give donation, like other people can give donation. So it's a kind of an association under our Companies Act. But what we are having, the applicant that we have, they are not deemed as association, they are company, they are legal person, which need to pass the test, which need to have the directors, which need to have the minimum capital to pass the solvency test, etc. So they are just like a limited company.
Okay. So if they are unable to meet the company's requirement, is it then possible to consider them under some other kinds of legal entities that your law permits, just so you could draw some regulatory framework around them?
No, it won't be possible, because at some point in time it was the regulator who told them that they need to separate their funeral director and their funeral scheme. And the funeral director, they set up a new company, where the funeral scheme, they set up a new company. These companies who are applying for a license. And the funeral director, the funeral services, are a separate company, which is not under the ambit of the Financial Services Commission. So at this stage, it will not make sense to tell them to change their whole structure again. But
We could have been looked into that decision a lot more carefully. And as you say, there are other legal entities like associations or mutuals that we could use, and that could help us to go around these capital requirement issues. So probably, yes, I know the decision has been made, but the current situation also continue to expose the members to those services without the protection of the supervisor. And as we practice and both literature have shown, the unregulated or the informal market are exposed to too much risk. So if it's possible to take another look into how we could tweak the legal framework so that we can wrap some supervision around these entities. My humble suggestion.
Okay, thank you very much.
You're welcome. All right. So we still on this issue, I mean, so this is very much in line with the discussions that we've been having. Yes, I see another hand up. Go ahead. Right. Okay. So in order to ensure diversity and flexibility, so Safwana, these are some, they are not suggestions, these are some examples of what has been done in other jurisdictions to create flexibility around what kind of entities are eligible to operate in the inclusive insurance market. So you could look at permit mixed entities, small entities, composite insurance entities, pilot schemes, dedicated licenses. I would briefly talk about these, and then we will take we'll go into groups and have a little discussion around these where we could share some ideas and see what could be done. Safwana, I still see your hand up. Is there another question you have, or is okay? Thank you. So mixed entities are entities that sell insurance in addition to other product or services. So in some jurisdictions, in order to create room for entities to be flexible around who qualifies to play in the inclusive insurance market, to reach out to the inclusive insurance customers, mixed entities are allowed, and these entities play quite a crucial role. So they engage in both insurance and non-insurance product. Usually the non-insurance product is likely to be bigger in size than the insurance product, because some of them usually to be a mutual. And you know, mutuals are built around occupations. You could have, say, tea farmers or say corn farmers having a mutual, and then they will set up an insurance scheme to protect their members. So this then becomes a mixed entity, and in some jurisdictions, these mixed entities are allowed to operate so that their insurance business has some kind of protection. Small entities, these are entities that are very small in size, either in geographical location or the size of the business that they do. We, however, need to be careful here, because the entity needs to be of a certain size to be able to pool risks. So even though there is the room for small entities, there has to be some mechanism around how small it must be to be able to pool risks, and what kind of controls can we have around it to be able to manage those risks and provide the insurance services. Composite insurance entities, we know, are entities that do both life and non-life insurance. In most or in some jurisdictions, The framework prohibits composite. They have an insurance company is therefore either a life or a non-life company, but under some circumstances, they are able to allow composites in the inclusive space, just so they build some efficiency and enhance access. Pilot schemes are used to test an approach, and in most jurisdictions, they are allowed to be used to test certain things before they are actually formalized. And there are rules or controls built around them, quite similar to what we have under the sandbox systems, so that they can be used to test out things and have controls in place. So when things go bad, there will still be some protection before this is generally upscaled in the market. And dedicated licenses are where certain entities are allowed to do specific kinds of micro insurance business, and they are dedicated to just that, and then they are given the license. It gives them focus scope, and it aligns their activities with their capabilities and allows them to provide some kind of service that is not being provided by others in the market. So these are some diversity that promotes flexibility around the prudential rules that we often find in our jurisdictions that have worked in some other jurisdictions. So with that, we will go into groups, and 4 groups, and in each group, what you are going to do is that depending on which of these entities are assigned to you, there are 2 things you discuss in the group. Identify the main challenge. So one thing that I need to probably mention before you go into the groups, even though these flexibilities, these entities provide flexibility and help to remove or help to manage some of the barriers that we find, they come with their own challenges and risks. And so there is the need for us to have appropriate controls in place to manage these challenges and risks, so that we don't create instability in the market. So this is what we'll be doing in the group work. So first of all, identify the main challenges or risks posed by the nature of the entity to effective prudential supervision. So the entity that is assigned to you, what kind of challenges or risks do they pose? And then the second one, briefly outline possible solutions or measures that could be used to mitigate the risks or challenges. I hope the questions are clear. That we are going to have 15 minutes in each session. Group 1, you are going to deal with mixed entities. Group 2, you are going to deal with small entities. Group 3, you are going to deal with pilot schemes. And Group 4, you are going to deal with dedicated licenses. So we'll break into the groups. We'll have 15 minutes, and then we'll come back and sort of, when you go, just and appoint one person as your spokesperson, so they can come back and note down your points, so we can share ideas on the risks and how we could possibly have controls around them. So Pascal, can we get the breakout rooms ready so we can go and discuss these issues?
Thanks, Kofi. Yes, Rochelle's just putting those together.
Yes, I'm opening them now, and you'll see which room you're assigned to in the corner. It will say room 1, 2, 3, or 4, and then you'll be able to identify your topic.